I will provide our firm's view on the key risks that the securities service sector is currently facing, as well as discuss FiinRating framework to assess credit risk profile of the securities company. Can we move forward? Okay, so in before this slide, yeah, go ahead, move forward, please. So oh, yes, so this slide shows our the FiinRating framework for assessing credit risk profile of a securities company. FiinRating follow S&P methodology of assessing business position, risk position, capital and earnings, and funding liquidities. In business position, we assess a securities company business stability and diversity. When assessing stability, we look at their market share in brokerage service, the company track record, their growth, as well as their business mix. They are more traditional brokerage company where they focus on brokerage and margin lending, or are they focus more on investment or prop trading? And are they active in the IB segment? When assessing diversity, we look at the company's product and services, their channel, as well as the channel and their client base. By examining these fields, we eventually can assess whether a company business position is helping or hurting its credit profile now or in the future. Sorry, is there any lag going on? Okay, sorry, I'll continue. In risk position, we assess the company's risk management to see if the company has a clear and structured policy in place and if they are adhering to that policy. We do that by trying to answer the questions, are there any concentration in their investment in certain group or industry? What is their stop loss threshold? How do they select eligible ticker in margin lending? Are there any risk management system in place to monitor and enforce the policy? A company in place with regular monitoring for control. In capital and earnings, we look at the company capital scales and their gearing level. If are their capital sufficient? Are they gearing on the more or less conservative side? We also look at the company's earnings ability to see if the earning is stable or fluctuating over times, or if the companies are operating efficiently in terms of cost. Because the nature of credit rating is forward-looking, we also examine whether the company has any equity infusion plan in the future, how feasible that plan is, and we try to figure out how it will impact based on the assumption gathered from information and through our working process with the client. In funding and liquidity, we assess the company ability to raise funds to borrow from lots of credit institutions and at what rate. What are their credit limits at each credit institution and how much have they used? Are they able to raise funding offshore with longer terms and or lower costs? This also affects the company's liquidity, as many securities also borrow short-term a lot from margin lending. Along with our projection, we perform stress tests where we come up with realistic low case or worst case scenario to see whether the companies will have liquidity issue given a certain circumstance. Along these modifiers, we also look at the company management to understand their strategy, their risk appetite, as well as their ability and experience to respond to market volatilities while still remain competitive. This is because management have, in addition, because of the nature of credit ratings, we also perform quantitatively peer comparison, where we compare the company key credit metrics along with the sector and the selected peers who share similar characteristic and business mix. Finally, to complete our assessment, we examine any external influence they may have, positive or negative parents' willingness to support the company and the ability to do so. as they are becoming more and more important to the parent banks. However, as we examine several cases of bank-backed securities company, we also realize that each of them have different influence level, and therefore bank-backed securities company do not necessarily have higher ratings than non-bank-backed securities company, because in the end of the day, a company's internal credit profile is still quite important. Can we move on to the next slide?
Already?
Yes. Yes. So in this one, we look at key risks that a securities company may face and their impacts on each of the business line. Obviously, as you can see here, each business is impacted by several risk drivers, but the impact level is quite different. For example, prop trading and margin lending are quite impacted by the market, by regulation, and by the company's own management, while the rest are somewhat less impacted due to the Vietnam security sector development in the last several years. We move on to assess the risk level for each business segment of the security services. Can we move on? Yes, so this slide is quite heavily texted with the assessment and rationale for each segment, but ultimately it comes down to three main points. The first point is that prop trading, which has contributed about 40% in both revenue and profits of the sector in the last 7.5 years, is assessed as the riskiest segment due to the segment natural dependent on market movement and therefore subjected to market risk. In our opinion, this segment will continue to be the most volatile segment of securities company in the near future, as the sector portfolio has seen a significant shift toward unlisted corporate bonds in the last few years. The second point here is that the securities service, which consists of brokerage and margin lending services, is assessed as low to medium risk, with brokerage being low risk due to the business nature, and margin lending being medium risk, as the segment is impacted by many risk drivers, especially market, credit, and management. As the market is anticipated to maintain the sideways trend, as Mr. Thun has mentioned, companies are focusing to compete more in margin lending for higher profitability, and with the investors' sentiment slowly recover, we view the security service segment as slightly optimistic in the near future. The third and last point is that underwriting, or IB, is also assessed as the low to medium risk, similar to security services. However, the segment is anticipated to significantly decline in the near future because of new regulation limits the pool of professional retail investors who are previously the segment's significant customer base. The Decree 65 also make it more difficult for securities company, as there are more steps involved and there are more information have to be disclosed. In addition, securities company may also face certain reputational risks to the public when the issuers are in trouble. Can we move on? So in the next few slides, I will go a bit more detail into each segment risk assessment. We'll start with prop trading segment. I'd like to draw your attention here to the graph on the left-hand side, which show the average return on portfolio of securities company prop trading versus VN index return in the last 7.5 years. There are two key points in this slide that I would like to address. The first point is that since 2016, securities companies prop trading yield, which is the yellow line, has been showing a more stable trend when compared to the market movement, which is the blue line that you can see. Due to the securities company own expertise and research capabilities, as well as tightened securities who also adopt a long-term investment strategy that also get movement. This is a quite positive sign, considering this is the most volatile segment in the sector. The second point here is that since 2018, there has been an increase increase in securities company and 2021 period when investment in unlisted bonds doubled. In the first half of 2022, this figure dropped back down to 2019 level. We'll go more into details on this in the next slide. Go ahead. So this graph in this slide shows the top 10 securities companies in terms of corporate bond balance as of the end of 2021. We also show the bond balance in the first half of this year, 2022. Here, either decrease or maintain approximately similar level of holding in corporate bonds. The other half increase their holding in these C bonds. Now, to really understand and accurately assess the risk level of each company here, we would really need to examine their corporate bond portfolio and see the in and out of these bonds during the first 6 months of 2022. And normally when we rate a company, we would acquire this information. Another point I would like to address here is the proportion of corporate bond balance. Sorry, what's that?
When and then we would like to hear some view from Paul and Pricey on the corporate bond exposure and on this slide.
Sounds good. Sounds good. Another point I would like to address in here is the proportion of corporate bond balance of the securities company compared to the equities level. As you know, here, the Circular 121 requires securities company investment in corporate bonds to be less than 70% of their equities level, and some companies are approaching that level. If the companies want to hold more corporate bonds in the future, then they would need to raise the equity level. This, along with the regulation on margin lending cap, would explain why there has been an equity infusion trend among securities company in the last year. Yes, Anh.
Yes, I would like to hear some comments from Paul and Pricey about the quality of the Vietnamese corporate bond. You may heard about from our rating action, and given no secondary market for liquidity. So how do you think the impact for the performance of the securities company who are holding significant portion of the corporate bond in their balance sheets? So. Like this.
Well, I'll say a few words, then move on to perhaps we'll let Prachi go into more detail. As Mr. Kwan was saying, I think the key thing is getting to know what's in those portfolios of bonds. Obviously, a lot of the issued corporate bonds, well, I guess there's two groups. A lot of the banks issue bonds, and generally we would assess most of those as being relatively low risk. On the other hand, you do have a large volume of bonds issued by property companies, which is traditionally a relatively high-risk business. And as the world gets more correlated, as markets turn down, you probably will have real estate markets turn down at the same time. So these risks of business volumes falling and risks within the bond portfolio will probably go up at the same time. But as Mr. Kwan said, the key thing that we would be looking for is not just the actual volume of bonds, but exactly who the issuers are and the degree of risk there. And again, looking at the liquidity makeup of the company itself. So most of their debt is short term. That's quite well matched with margin lending. If, on the other hand, they're borrowing short-term to fund long-term corporate bonds, that's obviously a liquidity risk that we would be concerned about. So I'd emphasize you really do need to look at each of these securities companies and get that sense of what exactly what names they've got in their portfolios, how they're funding it. Prachi, would you like to talk some more?
Yeah, sure. Thanks, Paul. So, I mean, just to elaborate what Kwan and Mr. Paul has mentioned, it's very important that we assess the quality of the corporate bond portfolio on an exposure to exposure basis. And this could be having varied levels of risks, as they could be different quality. Inherent quality of the issuer of these bonds is extremely important. We also look at sectoral exposure. Let's say a company is heavily invested in corporate bonds to a particular sector. In most cases, this would be property companies, as Paul is mentioning. It can be fairly risky. If there is a market downturn, of course, the broker is impacted because of low volumes on the business side. And again, because of a low downturn in the market, these corporate bond portfolios could also be impacted. So it's like a double whammy for the broking company. And that's why, we take this as a very central factor in our analysis and evaluate exposure by exposure basis, what sort of a quality of portfolio the company is holding, not only currently, but also what we expect in future. And we incorporate that into our ratings. Thank you.
Thank you, Prachi. So, Kwon, do you want to keep going with the brokerage?
Yes. So for brokerage service, I'd like to draw your attention to the graph on the left-hand side, where they show brokerage service revenue over the years, along with the brokerage service margin. 2021 was a very good year for securities brokerage services, where the average daily liquidity was around 25 to 26,000 billion, almost 4 times higher than 2020's, when the daily average daily liquidity was around 7,000 billion. The first half of 2022 is looking good, even better than 2020, simply because the first quarter was still good, continuing the trend from 2021. However, with what happened in the second quarter in 2022, and with our view that the market is maintaining the same sideways trend and maintain the same daily liquidity level of Q2 and Q3 2022, then it is likely that the brokerage revenue of 2022 will not meet the 2021 level. In addition, securities companies who rely on their retail client base will have their brokerage revenue somewhat more impacted by the retail investor lower sentiment in comparison to companies that have higher institutional client base, still quite stable due to its fee-based nature, and we maintain our view that this is one of the less volatile segments. For margin lending, I'd like to draw your attention to the graph on the left-hand side. After its peak in the Q4 2021 and Q1 2022, the lending balance also started to decline since the second quarter, sharing similar trend to brokerage services. Obviously, this will affect earnings and business of securities company, but from a credit rating perspective, we don't view this as a negative sign. As the markets decline and we anticipate it to maintain the sideways trend, the fact that lending balance is reduced show that companies, they are not increasing their risk appetite, and by lending less, they would also reduce their short-term borrow at credit institution, and this will ultimately lessen the pressure on their liquidity position. However, we do anticipate that the competition in this segment will increase as the investor sentiment recover, and many top securities company, they are raising equities to increase their capabilities to prepare for this. And with this, I'm going to pass back to anh Tuấn.
Thank you. So thank you, Kwon, for presenting the risk assessment on each of the 4 main components of the securities company's model. So now we have received a couple of questions from audience. So we divided the question into 2 groups, and this is the general question. So about the market and about overall issue. So I would like to go to some of them, and would like to hear the view from the speaker here, and then we will go into some other topics, the next topics at the program. So first question, the people ask, given the low liquidity of the market since early this year, so what are the impact to the earnings of Vietnamese securities company in this year and the year coming? So anyone to have some comments on this?
Hello, Infant. I think I can address this question. So as Mr. Quinn mentioned, the brokerage revenue is some kind of main source of income for securities firm in Vietnam. So of course, the low liquidity of the market since early 2022 is having a negative impact on the earning result of Vietnamese securities firm. But notably, even though the liquidity level has decreased in comparison to 2021, it is still much higher than the previous 6 years. You can see from the figure, the daily liquidity is now like 17,000 billion daily. It is, I think, a remarkable increase from the previous level of, I think, less than 10,000 billion daily. So of course the earning is affected, but still it is a stable profit margin sector, and I think the profitability is affected, but not to the level that it will cause a huge negative impact to the operation of a Vietnamese securities firm.
Thank you, Hoàng. So our data show that the forecast, the expectation on daily average for Vietnamese stock markets this year around 25,000, but finally it's not. But now currently it's about 13 or 15. We think it's still good, given the very low margin or leverage trading. So let's come to the second question. Many securities company firms have profited from corporate bond trading in 2021. But this year, the very low issuance activity. So how the situation will have an impact for the sector, and what type of companies in 2020 will be affected, or in a good way or bad ways? Quân, do you want to take up this question and have some sharing to the audience, to the people who ask, a fund manager?
Sure, Anton. So 2021 was a peak year, right, where companies, they were able to generate a good portion of their revenue from the IB segment, as well as the prop trading segment. So in here, they whatever the bonds that they can issue, they can distribute to the investor for IB segment, but also the bonds that they were holding. They also generate a good amount of interest for the prop trading portfolio as well. So in 2022, with the low issuance starting in Q2, will no doubt affect the underwriting segment of the sector, because if there are less issuer issuing bonds, then there was little less source of income in that segment. In addition, with the new regulation limits the pool of professional retail investors who are previously the segment very significant customer base. So that will affect that as well. And the Decree 65 make it a lot more difficult for securities company. There's a lot more steps involved in the process. There are more information that they have to disclose. So overall, in the short term, this will impact the underwriting activities, the company in the sector, especially the one who has been focusing on this sector, on this segment. However, in longer term, we do expect this segment to recover as the companies will familiarize themselves with the with the new process, the new processes they have to go through. And of course, there's still always demands for issuers to issue bonds to refinance, as well as the bond with good and decent quality are still very good investment or instrument for the foreign investor, creditor, as well as many investment funds. So there's still the lots of demand for the bonds in the future. So I would say that in the near future there might be some it will take some time, but eventually it will recover.
Thank you, Kwon. But I personally see some observation there, some risk there actually for the securities company who are holding bond on their portfolio, especially when early redemption with the court calling back to selling back by the investor, and depends on what type issuer. If the securities company who are holding the private bonds or by not so good companies, project companies, so that's something to be an issue. So I would recommend the investor to look at exposure, bond exposure, as we showed earlier, one by one. But the other point I think is good point for the markets in the time to come, for the company who have not involved heavily in the bond trading or issuing or underwriting. So that's the chance for them to step in this market with a better legal framework and better transparency in the time to come. So we have a few other questions, but maybe we should skip this. Do you think? So for the decree 65, we already addressed already. And maybe I take one more question, number 5. Here from risk management people from a local bank. So may I put question to Kwon again, if you can? Because many Vietnamese or local securities company who borrow from the banks in Vietnam. And the State Bank of Vietnam has recently imposed a number of measures to limit the credit exposure for financial asset and for trading the securities. So will that cause the liquidity issue for some company, especially at the current market condition? Kwon, any comments or any opinions addressing this question from the risk people?
Sure. So sorry, so my there's certain issue with my internet, so I'm gonna answer that through Huang's computer. So I think this is a very good question. Obviously it will cause certain liquidity issues for some securities company, but from our assessment of the whole sector, I think for many companies who have strong funding, who have strong capital base and funding ability, they will be as long as they reduce their exposure on corporate bonds and margin lending appropriately with the movement of the market, there wouldn't be I don't see the top securities company having this issue, and the smaller, very small company, securities company, they don't really borrow a lot, and mostly they just utilize their equities for their activities. So those companies, they shouldn't have this problem either. Mostly the mid-size securities companies who are utilizing and the companies who tend to have lower leverage level would be impacted by this situation.
Thank you, Kwon. I think we have few other questions, but I think given the time, I would skip that.